Hi, my name is Greg Sierra, and I'm going to talk to you about some basic accounting concepts just from the perspective of the Other40 competition and being an entrepreneur. This first presentation is going to be an overview, then I'll create another video with some examples. All right, I'm going to have some takeaways, and part of these have to do with the competition. Part of these have to do with the fact that you've expressed an interest in creating or running your own business. So, my first point is going to be that control is always the number one issue for a startup or a small business. It can sometimes get overlooked, but it's very vital, and we'll talk about that. Financial statements matter. They matter to you as a business owner. If you're successful, financial statements are going to allow you to get ready access to capital. So even if it's not a very exciting part of the business, you as a business owner have to figure out how to produce reliable financial statements. With respect to the competition, we're going to talk a little bit about pro formas, but really in the second video, we'll talk about the details of what's needed for the competition, some ideas about it. They're not totally set in concrete. I know some of you, when you get to that point, will get hung up in the details, and we'll talk about how details do and don't matter, especially with respect to assumptions that you just have to make because you're doing something that hasn't been done before. And finally, we're going to look specifically at one case of break-even, and in a break-even, using a break-even analysis as a way to think about your business, even if you don't use it in the actual presentation, it can help you create the financial statements. All right, what is control? Control is made up of methods and procedures that are going to limit the access to assets and are also going to limit authority to decision making. Control also just prevents errors in reporting. So control's purpose is to protect assets, but also protect the integrity of your reporting system, which enables managers to rely on the information and also outsiders like investors as well. Control ensures regulatory compliance. What does that mean? Well, paying taxes is regulatory compliance. If you have poor control, you may not properly be reporting revenues and expenses. There are other compliance issues, maybe government, EPA guidelines, and so forth, and accounting controls will fit under that. But taxes is one good example of regulatory compliance. So limit access to assets and authority. I say it again because it is absolutely the most vital and important part of control for a small business. Many successful small businesses, in the sense that they have a product that's demanded by customers and they're able to charge a healthy price, fail because they don't limit access to assets and authority. So here's your rule, and this is really for those of you who haven't had business experience. Don't let anyone except yourself, anyone, access the corporate checking account. By far, for small business, the most common control failure is when someone improperly accesses the corporate checking account. Okay, so I wanted to touch on this because even though you may not be thinking about it, you're thinking about the competition. Regardless of how you do in the competition, I know many of you may go on to start businesses, and I just wanted to take this opportunity to be sure that all of you understood the importance of controlling access to assets, in particular the corporate checking account. With respect to control, if you have a simple business, the controls are simple. You're going to have to properly title property, like intellectual rights and other major assets like real estate and vehicles, just properly title the big costly assets in the name of the corporation. All right, now on to financial statements. Either figure out how to do it well yourself or in your organization, or get an accountant, because your future access to capital depends on it. In particular, for the vast majority of small businesses, bank loans are really the first and best source of capital. The rates are low. They're the gold standard. Once you're accepted by a bank, then other investors will use that as a seal of approval and be willing or more willing to invest in your company. But primarily, it's going to be your cheapest source of funds will be bank loans as a small business. And banks will not, without security or collateral, which is probably why you're in a competition or why you might be out seeking angel investors or that type of money. Without collateral, banks are going to need typically 2 years of audited financial statements to begin a lending relationship that is unsecured. Take advantage of internal information. So internal reporting is going to help you with pricing and marketing. If you use your internal information well, it'll tell you what's selling, what's not selling. If you change the price, what's the effect on selling. It'll help you improve operating efficiency, and it also serves as a control to prevent theft. If people know you're keeping track of stuff, if employees know, frankly, it's going to be they're going to be less likely to misappropriate assets. Okay, now the reason you wanted to meet with an accountant for the Other40 is you want to make these pro forma statements or some type of financial presentation as part of the entire package that you're going to present and submit. So, I have to cut over to the spreadsheet. Okay. So what you see here is a break-even analysis. And on the left-hand side is the annual profit in thousands of dollars. So that's the vertical axis, and the horizontal x-axis is total client hours per week. So this business is a client-facing business. It's based off of a real fact set. And in this business operation, they had a range of outcomes, and their profit depended on how many client hours they served per week. And at 120 hours per week, depending on which rate they were charging, they have a $60 rate and an $80 rate. So there would be some blend of these two. They had employees that were able to charge $60 an hour, and some other employees that are able to charge $80 an hour to the client. So without specifying a specific proportion, they knew that the profit would be between those two for 120 hours per week. So as you see here, they break even. The zero line is way down here, around 50 or between 55 and 65 hours per week, depending which rate. But if they had 120 hours per week, it was a good profit for the office. So this was a sole proprietor. So the proprietor at this 60 to 100,000 level for the second year of operation would be pretty satisfied with that at that point, and would hope to continue moving to the right. So one way to look at using your information is if you have a profit per hour, per unit, per something, and you either have this is a dollar range you have here for different units, or if you just have one unit so you'd only have one line, then a great way to use your information is to plot a function like this where your profit increases per unit. And this will kind of tell you your risk, because let's say in this case the best they could do is 100 hours per week. That would max out their capacity. Well, they don't really have a good top end. Now this business is, you could replicate it, so theoretically there's no top end. But if you have some marketing information and you have a range of potential outcomes, then you could point to a potential outcome. This dashed line on the 120 I think my recollection was it was about 80% of their actual physical office capacity. They plotted out hours, they wouldn't have people coming at midnight and that kind of thing. So it was the total hour capacity of the office that they had. So this would be for their current building would be where they'd expect to be. Okay, so that's this situation. Each situation is going to be very different. So that's when we meet face to face. If you ever having trouble figuring out what's driving your business, I might be able to help you with that in a face to face talk, or hopefully before we meet, you'll be able to figure that out. But you might need help analyzing it and putting it into a quantitative framework to develop a chart or something like that. So moving on with the break-even analysis. It's not always necessary. It's a very powerful tool, but it's not always necessary. When your per unit production cost is low, you don't really need it. The example of that is one competitor last year had a gaming software. It was $40,000 up front to develop it, but then the cost of production was essentially zero. So the break-even analysis is pretty straightforward. If it's $30,000 to create it, and you can sell it for $10 a piece, then it's $30,000 divided by 10, because you just have one fixed cost. So also, if the capital investment is smallish, it's not as vital. So it's going to be helpful in your case if your per unit production cost is high and there's a large capital investment. You want to see how many units you have to sell to get to break even, because it'll help you kind of understand the risk of the large capital investment. So you're going to have to get some marketing data to come up with projections of units sold and pricing. I'm not a marketing guy. I can tell you, given past experience, if something looks reasonable or realistic, but you either have some expertise, perhaps because you've been working in an area or studying an area, or you're speaking to people who do, or you've done some research on the internet with industry groups that are giving you realistic numbers. All right. So you have to determine if your venture is realistically profitable given prices and quantities to break even. So will the market bear the price, and at what price? What's the quantity? Last year someone had some exercise equipment they were going to manufacture. That's a higher dollar amount. There's a price range in the marketplace. In that particular case, I don't know the details, but was it an expensive piece that people were going to demand because it was innovative, or was it a piece that was coming in at a lower price and just as good as the higher price competition? So those are the kind of things in terms of marketing that you'll have to figure out, not only pricing but also quantities. So my help to you isn't in coming up with the prices and quantities, it's in putting it in the analytical framework. We can do some back testing and look at, is this realistic in terms of an industry in general after you produce it. And here's a real simple example. So it's from that graph you saw, but it's kind of broken down. To create this, it might be a little more involved. This one was much more involved because it took a lot of accounting data to come up with these numbers. So their average fee is $60. The therapist gets their money, and then the billing fee would be subtracted from that, and then the margin is what's left over for the business. Okay, so they come up with, this is an example of coming up with your revenue per unit service. So everything above, if you're looking at the left column, everything above the $26, everything above this, and let me see if I can, so everything above this $26 is variable. So you want to come up with this variable piece first. All right, and here are the $60 and $80 scenarios. You may just have one. price for one item you're selling. And then you come up with all these annual fixed costs. So the total fixed expenses, this is to keep the office open if nobody showed up. You'd have rent, you'd still have to have a support person there, other professional services such as attorneys and so on, insurance. So if you didn't have any customers, if this business had no customers, they'd still be paying $93,000 just to keep the facility open. And that's where this spreadsheet came from. Okay, so you start down here at minus 93,000, which is the investment per year. If you have a multi-year capital investment also, in addition to the annual fixed costs, you'd have to allocate a portion of that here. We'll talk about that when we meet face to face. And then, once again, you all might have just one line, say you're selling yours for $80 per unit. Once you get to about 80 or 55 units here, you're break even, and then you can start talking about profit. Oh, James Murphy is not here, so there will be, let's see, let me grab the pen. So this is not James Murphy, and this is not the date. It may be in the CBRC, but they have not yet informed me of an accounting support person. So we'll see. Typically they have somebody, but I'm around. gsierra at siue.edu. You can email me with questions. And of course, we're going to have a workshop. I think is it March 3rd at 6 p.m. Double check that. But it's coming up this week. So I'll be there. I'm going to run the face-to-face more like a workshop setting. If you have some numbers that you've started and I can help you with, we're going to try to knock stuff out. In the past, I've gone through this PowerPoint and then taken a few questions, but I want to have more time for your questions. I think that's more helpful. You all are kind of under the gun. If you have questions before that, you can also email me there. gsierra at siue.edu. Otherwise, I look forward to seeing you all next week.